Welcome back to Morning Markets on Thursday the 23rd of February. Yesterday we received the much anticipated minutes from the US Federal Reserve, so the US Central Bank meeting which took place at the beginning of the month. Here on Morning Markets we discussed the decision from that meeting at the beginning of the month, which concluded with a 0.25% increase in interest rates in the US, taking the target range to a level of 4.5 to 4.75%. From the minutes which were released yesterday, we can see that this decision was backed by the majority of members. However, there was a minority of members who voted for a 0.5% increase in interest rates. The 0.25% increase was the smallest hike which we've seen since the interest rate hiking cycle commenced in March of last year, which started to set a more dovish tone, so a less aggressive tone amongst analysts, and the expectation that we could actually be within touching distance of the peak of the interest rate hiking cycle. Since the meeting at the beginning of the month, we've had some further data points which have pointed to a positive trend, and that is inflation coming down. This is forming what we call a disinflationary environment. So for context, headline inflation has moderated from the summer highs of 9.1% to a level of 6.4%. However, what is evident is that the easing of inflation is starting to slow down. So for context, if we look at the core components of inflation, which strip out energy and food prices, so the more volatile aspects, then we can see that inflation moderated by just 0.1% in the month of January when we look at the year-over-year data to a level of 5.6%. And if we look at core PCE inflation, which is the Fed's preferred measure, we can still see that this reported to the end of December was 4.4%. So the theme here is all of those readings are above the central bank target of 2%, suggesting that there's more work to be done here. Another data point which we've seen through the course of the month refers to labour markets, the employment market. And what this has shown is continued strength and resilience there at a time in which the Federal Reserve is trying to cool demand, consumer spending on goods and services, and also wage pressure to help them achieve that inflation target of 2%. The minutes highlighted that on balance, despite a rapid rise in borrowing costs, the credit quality amongst households actually remains relatively robust at this point in time. Through the month, these important data points have actually fed into market expectations. And the expectation which analysts have now baked in is that interest rates, which were expected to peak at around 5%, are now expected to peak at a level of around 5.5% in the US around the summer of this year. And expectations that we did have in place of interest rates being cut towards the back end of this year have now all but been removed from those expectations. So on this basis, the minutes reflected broadly what the market has begun to price in, and therefore the market moves on the back of the minutes were relatively modest. However, what was interesting to see, if we look at the minutes relative to the decision, we had a more dovish decision, however, more hawkish tone set within the minutes which came through, with a few members voting for a 0.5% increase. The developments of the central bank in the US will be very important as we look over the coming months. So please do tune in to Morning Markets to keep up to date with those developments. Thank you for watching.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.